This podcast is for entertainment purposes only and does not replace your own financial, tax, legal, or financial product advice.
Hello Australia, welcome to My Millennial Money. I'm Glenn James. Thank you so much for having a listen today. If you are new to the podcast, welcome. Please make yourself at home. If you're an old hand at this thing, you know the deal. Sit down, strap in, and let's have a good chat. Today we've got Paul Benson, who is a fellow podcaster. He's got a podcast called Financial Autonomy, and we talk about a few different things in this podcast episode. We want to talk about P to E ratios, and we're going to talk about some examples. We'll talk about gearing, debt recycling. We'll talk about what investments to use for each strategy, how shares make money for you, how to build an investment portfolio. I'm going to have a lot of fun with Paul, and we can't do this podcast without our episode partner, and that episode partner today is OpenTrader. OpenTrader is designed for professional investors and those who want to invest like a pro. It's about informed decision making, having the right data at your fingertips in a form that you can quickly understand. You can customize your workspace to suit your investing style and access live feeds with the app to get the latest stocks you're interested in. So thank you to OpenTrader for getting behind My Millennial Money. And it was actually funny, in this episode, I actually used OpenTrader when I was chatting with Paul about different shares and when we were researching the P to E ratio. So thank you so much. And if you love the podcast, jump into the Facebook group, follow us on Instagram, give us a review, all that stuff. I'll see you guys soon. Paul Benson from Financial Autonomy. Welcome back to the show, Paul.
Hey, g'day, Glenn. Thanks for having me on.
No worries. Now, let's just get into it. Is there a stigma around investing in shares still? And do you think that's changing? Like, you're a little bit older than me. You've been a financial advisor for some time. You know, we know Australians love property, and we know that people will blindly walk in and buy a $500,000-$600,000 property without doing much research, but they'll freak out about putting $5,000 in share market. So do you think the stigma is changing?
Yep. It's a generational thing in my experience. So, you know, I still have people come in, and if they've so perhaps they come in and they're in their 60s, for instance, and they've never invested before, maybe they've got an inheritance or a divorce or something like that, they'll still come in with the old sort of perception, shares are risky and it's a form of gambling and this sort of attitude. But I don't see that at all in the younger generation. And I think it's because of all these fantastic apps and ability, the way young investors now can get into the market and get exposure for relatively small amounts of money, so they can have a try, they can have a go, experiment a bit, and it's just breaking down those barriers. So, yeah, I think that perception, it's still present in the people in their 50s, 60s, 70s to some extent. If they haven't had the opportunity to invest when they were younger, it's kind of too late. But I think for younger people, in my experience at least, no, it's past.
Reading into the psychology of society, do you think we can draw parallels between that older generation, like someone in their 70s may have had the one job for life with Telstra or with the bank or whatever, and changing jobs or changing has inherent risks. So you get your one job for life. Now, all of us pretty much under 40, we're not in the one job for life. Like, I'm into my third, fourth career right now. So do you think risk is more inherent in younger people?
Yeah, it's interesting because that circles back a bit. So you say risk, but you know, as you touched on there earlier, people, they don't have trouble, all right, spending X amount on a huge hundreds of thousands of dollars on a house, and yet, is a $5,000 share investment risky? Some people would think so. So I think the younger people are maybe appreciating that, in fact, it's not that much risk. And particularly some of these convenient apps, I mean, the intention with investing ideally is you're putting money in that you're not going to need for multiple years. But what we can see is it's so easy. Something changes. I want to buy this on the weekend or something. Well, you hit sell and you've got your money back, depending on what you're using in hours or at worst a few days. So it's really liquid, and it's so I guess, yeah, from a risk point of view, I don't know that people are kind of viewing it that way.
Yeah, and I guess it does come back to education, right? And like, I've got a little Raise account, and I've only recently got it actually because I wanted to get into the Razor Awards. And this is not sponsored. But it's just good because, I think I wouldn't have more than $100 in there. Like it's literally just there. But it allows you to literally put your toe in the water, and by toe, put your pinky in. Like, you know what I mean? Like, and you just start to feel and understand. And a lot of people say, well, when do I move from Raise or Spaceship or whatever? Well, it's like you will know when it's time because you'll start to research and learn more yourself.
And the great thing is, and circling back a little bit, but as I say, it's really hard if you are in your 60s or 70s and then you get a lump of money and how am I going to invest this? Of course, it's daunting to go, oh, well, I'm going to invest it in shares or potentially even property. To get that experience now, as you say, things like Raise, small amounts of money, even if you blow it all up, you've still had that fantastic learning that then equips you later on when you do get the inheritance or something else is going on. You go, okay, I know how this stuff works. Like it really is fantastic, that opportunity, I think, now.
Yeah, and last year it really was, it sucked, with lockdowns and whatnot. And as we're recording now, most of Sydney, Greater Sydney, I'm in lockdown. I think Gold Coast, Brisbane is in lockdown. Melbourne's had its fair share of lockdowns. We've
had plenty of practice down here in Melbourne too.
I think, looking at the share markets last year, and I want to do this as a live example. So if you're not driving or if you're laying in bed or whatever, I've just got my Apple phone up. I've hit stocks and I've opened the ASX 200, which is the AXJO index. Now, I'm just putting it to 2 years, and you can see that on the screen, Paul, that big cliff. Mm-hmm. Now, it's a great time to understand investing markets because over the last 2 years, if you just didn't touch your super, if you just kept pumping your investment portfolio, there wouldn't be a problem. You wouldn't be telling people at the weekend barbecue or at the cafe that I lost all my money in shares. But if you did sell at the bottom in February 2020 out of fear, well, you would have done your ass. So I think you're right. It is changing and these apps are making it more accessible.
And only slightly related, and I don't know that it applies so much here in Australia, but just while I was eating my lunch today, I was watching a presentation about Robinhood. They just had the IPO last week, the trader there in the US. They're making more money off options trading than shares these days, which is interesting. Wow. So over there, the traders, they've got so comfortable with shares that that's not aggressive and perhaps risky enough, and they've moved on from shares, and now they're doing options over the top of shares, which is it's a leveraged way to trade shares, right? So
I know.
Amazing.
Yeah. And if you do want to listen to a deep dive, I think the week before last we did a campfire chat with Ivan, the CEO of Open Markets, and we actually spent some time at the back half of that episode about options and puts and calls and all that. If you want to go back, and we will swing back around with Ivan and maybe get a bit more deeper for those who want to understand that. But conceptually, your book, Financial Autonomy, and I'll put a link in the show notes for anyone who wants to grab a copy. And you were nice enough to send me up, I think, 10 copies last year, and we gave a heap away to listeners. You've kind of got this pronged approach. So you set your goals, manage your cash flow, buy stocks, buy property, or become self-employed. Doing either of those or all of those will enable you to gain choice, aka get financial autonomy. How's the book gone? Like any word on the street, like good feedback, bad feedback?
Yeah, the feedback's been really good, and it's certainly, as you touched on at the start. I mean, I put food on the table. Financial planner. That's how I make my living. And the book's been fantastic. A number of new clients we've had. Oh, how did you come across this? Oh, well, I read your book, which is perfect. Because then they kind of know where we're coming from to begin with. So, no, very happy. And I don't know, are we allowed to say it, Glenn? How's your book? Is it a secret, or are we allowed to talk about it?
No. A few people know about it. I don't want to talk about it too much, but only because people are sick of hearing about it, and we haven't really launched it yet. But the media copies have been printed, and they've gone out to media under embargo and all that stuff. So yeah, it's pretty much ready to go. But it was interesting, Paul, when I was writing the book, I was in New Zealand, and I actually took your book to copy it. Just joking.
Go with the key resource. I understand.
Yeah, that's right. Well, you got to build on the stuff that's there.
Yeah.
But the reason I took it with me was, I wrote my chapter on shares, for example, and investing. And what I then did, I then went back to some different books to see what they wrote and what you wrote about it, because I didn't want to write the same that people have covered, because I wanted it to complement. But I was pleased to know that all the stuff in your book is actually different than my stuff. And what I want to talk about today is maybe a little bit around, direct shares, and we can talk about how people conceptually can make money with shares. And then, in your book, you talk about P/E ratios and how they work with valuing a stock, where I didn't get into the weeds that much. I got more into the weeds around maybe ethical investing and asset allocation and all that. So it's a great book, and and I wouldn't promote crap that I think's rubbish. So again, support Paul and what he's doing with the book if you are into reading, and he's got an audio book. But conceptually, how do we make money with investing in shares?
Sure. Well, I mean, your return on shares is two components. One is the growth, so the appreciation in value, the increase in value over time, and the other is the dividends, the income flow. And I guess you can compare that, I suppose, to property, where property you get rental is your regular income and you expect to get growth in the value over time. So two components to your returns. In terms of the capital growth, the interesting element about that from shares is that there's some logic as to why they should grow, because most companies, they generate a profit. They pay a portion of that profit out as dividends, but they keep some of that profit and reinvest it into the business. So your shares do have a natural logic to why they should grow and increase in value, because of those retained profits being reinvested. Perhaps they're used to acquire a competitor or something like that. For instance, as we've seen perhaps with Square taking over Afterpages this week. So by retaining profits, they're able to do transactions like that, or else they're able to invest in new products, new marketing, these sort of things. So there is some logic as to why your shares will grow. Now, of course, that doesn't mean every share grows, because not every business is successful, but that's why you have a portfolio and you diversify.
And it's interesting because the old school thought was, I'll keep my money in cash and just get interest from the bank account because, it's secure, it's stable. But sure, that was cute maybe 15 years ago when interest rates may have been 7%. But nowadays, the interest rates are rubbish, so you're not really getting a return. But there's actually never a chance of the cash to grow itself, where if you buy one share, that one share will produce a profit, but that one share will also increase in value on top of the profit or dividend, right?
And I think what you're touching on there too, around the fact that cash is paying nothing, that sort of relates to, you mentioned raise earlier and this sort of stuff. I think increasingly people are like, money that they might have sat in cash in the bank in the past, they're parking it in their raise account or something else like that just to get a return and to see a bit of growth. Because exactly as you say, there's just no reward for cash anymore. Yeah, it's interesting, but yeah, certainly there's your return. It's your dividend income. So that's kind of nice because it gives you a bit of stability. Even you don't always get capital growth. It's a cyclical kind of thing. Sometimes it's down, but you can just sit on your shares and accrue the income. And generally for Aussie shares at the moment, if you have a bit of a diversified portfolio, you're picking up 3 to 4% income plus franking credits, tax credits as well. International shares is probably more like 2%, depends on the portfolio you've got. But relative to what you can earn in cash, that's pretty attractive. So just the income alone is a good deal.
That's right. In your financial planning practice, if you had a client that just wanted to focus on, investing in shares, and you might set them up on a platform, is your personal vibe, a model portfolio of ETFs, or do you have a direct equity portfolio? How do you manage wealth for some of your clients?
Yeah, typically we use a core satellite approach. So we have a core, which will be a low-cost index fund sort of blend. And, it just depends on the person's degree of risk and time frame as to exactly what that blend looks like. And for some people, we'll just stop there. The core does the job. But I guess as the portfolios get a bit bigger, and depends a bit on the interest of the investor, then we'll add some satellites to it. So things like, you touched there on ethical earlier, or different themes, different angles there, and it could involve individual shares in that satellite. But you're trying to have a core that might be 60 to 80% of the portfolio that's really nicely diversified and pretty low cost.
Yeah. So when we go back to looking at researching individual companies, right? And let's just say the top 300 companies on the ASX or top 200, One of the first easy things to look at is the PE ratio, the price to earnings ratio. I was wondering if you'd be kind enough to maybe give us some practical examples of, when we see a PE ratio of 17, when we see a PE ratio of 11 or 32, whatever that is, what does it mean and how do we make sense of that?
Yeah. No, that's good. I think that is a really good way. If you're interested in individual stocks and trying to understand what to buy, understanding how the PE ratio works, I think, is really valuable. And it's not like there's a particular PE ratio that's good and another PE ratio that's bad, but it's about looking at that ratio and then reflecting on, what's that telling me, and does that make sense to me, So the PE ratio, price to earnings. So if you had a stock that said it was a PE of 10, then that means you're paying 10 times that earnings, or you could think about it in years, right? That 1 year's earnings, you're paying 10 years worth to get that 1 year's earnings. So typically, companies where their earnings are growing quickly, the PE will be higher because, of course, this year's earnings, next year it might be double that, and the year after that it might be double that, right? So if the earnings are going up rapidly, you'll typically see a higher PE ratio versus a company where the earnings are fairly flat, you'll tend to see a lower PE ratio. So for instance, BHP at the moment, which of course iron ore is going great, so they're having a great time, but at the moment their PE ratio based on expected earnings for the 2021 financial year, which of course has just ended, but they haven't reported yet, so they should be pretty accurate. PE ratio there on BHP is 11.2. So you're paying 11.2 times its earnings to buy that stock right at the moment. If you compare that to ResMed, which is a more growthy sort of company, it's trading at a PE ratio, expected 21 results of 50.5. So you can see there, a much higher PE ratio. So what that's telling you is, as an investor, you're paying a much higher price for the income that company's generating. And therefore, it's suggesting that the market believes that income is going to increase by quite a lot. I mean, roughly about 5 times more than BHP's is going to increase just based on those PE ratios. So if you're looking to do individual investments, you can think about that and think, well, do I agree? Does that resonate to me? And you might conclude, I think that's ridiculous. I think BHP's a bargain at that price. Or alternatively, you might conclude, well, I think ResMed's got fantastic prospects. Their profits are going to go through the roof. And yeah, I'm happy to pay 50 times because that's going to look really smart in 5 years' time.
And will the PE ratio, Paul, will that change daily with the share price?
Yes.
Yeah, cool.
Yep.
So it's a moving number, everyone.
Yeah, because it's the price over the earnings, right? So the price is moving every day, so it's a constantly moving thing. And there is, I guess to your point earlier, it depends a little bit which earnings you look at, right? Do you go backwards and say, well, how much was the earnings last year? Or do they forward look and say, well, what are the expected earnings for the current year? Generally, depends a bit on the time of the year, but especially at this time of year, they're looking at 2021 results. So the financial year has ended, but the company hasn't actually announced the profits. So the 2021 financial year profits should be pretty predictable. So we'd normally use the forward-looking estimates for sort of more usefulness.
Oh, interesting. But then again, like the PE ratio, it's not the be-all and end-all, is it? Like it's just one component.
Yeah, but I guess that's where I'm saying you're looking at that to just get a bit of insight and to just think about where it can be particularly good actually is if you're looking at the same businesses in the same industry. So say, for instance, if you decided, all right, I want to get some banking exposure in Australia, and we know we've got the big 4 banks, and it's a question of, well, do I buy CBA, ANZ, NAB or Westpac, right? You could look at the PEs of each and then think about, I mean, I haven't looked at them, so I'm just making these numbers up, right? But let's say, Commonwealth was at a PE of 15 and ANZ was at a PE of 10. Well, then ANZ's 50% cheaper relative to its earnings compared to CBA. So you think about, well, do I really believe that CBA is that much of a better business than ANZ? And maybe you do because you like their technology or whatever your reasoning is, but maybe you don't. And so that can inform you as to, all right, well, I'm going to put my money, I'm going to buy this stock instead of that stock, right?
Okay, so as another practical example, let's just do a comparison. Do you want to pull up the PE ratio of Rio? And then we'll have a look at Rio versus BHP.
So Rio's PE based on expected 21 results is 6.3. Wow. It's cheap.
Yeah.
Anyway, we're not giving advice here. Maybe it's not.
No. Well, And this is the reason why I'm about to, I wanted to use this commentary, and then 11 on BHP. So if you are interested in digging up stuff and investing in companies that dig up stuff, you know how we had the national tour and Open Trader was our show partner for the national tour? Because I've just got their Open Trader account platform up. And the reason why I thought I'd do the comparison, because they've got research in the platform, like a lot of brokers have, right?
Yeah, yep.
And, you know, Rio, their rating is a strong buy. So BHP is just a buy. So looking at maybe what the company's doing at the actual PE ratio, like if Glenn James was about to invest in shares in a company that digs up crap, I'd probably be looking at Rio over BHP at the moment.
Yeah. The other interesting thing, a PE of 6.3 is really low, right?
Very.
So partly what that's telling you is investors don't think the profit that Rio has made for the financial year just ended is going to be repeated, which probably makes a fair bit of sense because Rio is a far less diverse business than BHP. It's much more reliant on iron ore, and iron ore's had ridiculous prices. So again, it really gives you that insight. But yeah, it's a great example. Compare BHP and Rio. Which one of those am I going to go?
It's probably going to be Rio.
And think about what makes the most sense there, you know?
Well, and then looking at Fortescue, FMG, you know, well, I've got my, and obviously the PE ratio on Open Trader is the one that's looking back. Is that what we worked on?
Yeah, I think so. Hang on, I'll just get it so we've got the direct comparison. See, FMG, 5.3 PE ratio, so actually even cheaper than Rio.
Yeah.
On that measure alone, you know, there's other factors.
But I mean, on the aggregate recommendations that I'd imagine that Open Trader have, they're saying that the rating is a neutral, like it's a hold.
Yeah.
So
FMG is interesting actually because it's forever, like the researchers we use, I don't know that I've ever seen them have it as a buy, and yet it's had this extraordinary run. Anyone that was in it has killed it. They've made 500% in the last 5 years or something, and yet none of the researchers ever have it as a buy. It's very, very frustrating.
This is dangerous, this episode, Paul, because it makes you want to just go and buy a heap of direct equities, and I don't really do that. Let's do one more comparison for fun. Do you want to look at some banks?
Yeah, I know. Well, what if we pull up, I said before, Commonwealth Bank and ANZ, right? What if we put up those two? Yeah. So Commonwealth Bank, PE ratio is 21.2 on expected 21 results. 21.2. Let's have a look at ANZ.
Yeah, and I've got 17 from last year.
Yeah. ANZ, 13.6. So that's a massive difference. The relative value of Commonwealth Bank to ANZ. So the market is saying they've got a much higher expectation for the outlook for Commonwealth Bank, and therefore they're prepared to pay a much higher multiple of earnings than, sorry, I might have said that wrong. They're prepared to pay a much higher multiple of earnings for Commonwealth Bank than they are for ANZ. It's, it's quite extraordinary.
And interestingly enough, the aggregate rating on this Open Trader account is a strong buy for CBA, but just a buy for ANZ, which is weird because I was looking at CBA through Self-Wealth, and their research says they believe it's overvalued by 10%. So
there you go.
It's just one of those things. You need as much information as possible. And I wonder, Paul, like, if we kick this can down the road a bit, like, and it's like, okay, well, I want to start investing, you know, what do I do? And it might be that, well, I'm just going to put 80% in a diversified ETF, happy days, and then the 20% that I want a bit of hands-on because I've got personal interest and all that. Because it gets to the point, like if we're going down the top 200 of direct shares, you're going to be getting a dart and throwing it against the wall. But maybe it is more like well, what are you interested in as a person? What would you like to spend some time researching out of personal interest? Because I believe as an investor, if you are doing direct equities, it can't just be a money play, because for me personally, I'll never directly invest into Afterpay because I don't believe in what they're doing. I don't believe it's of good. I think it's of harm. Likewise, people might not directly invest into a company that's heavily in coal, for example. So any comments on, filtering out maybe some satellite funds in our portfolio?
I mean, I still think your starting point for the satellite is to go funds, as you just said. Go ETFs, because you can get thematic ETFs that can give you that satellite exposure without you picking individual stocks. The other element too is if, at least to begin with, generally you're focused on the Aussie market, and as much as there's lots of companies listed on the Aussie market, you're a bit limited in choice, at least in terms of industry sector. There's not a lot of technology, I guess, is the most obvious element of that. That's changing, isn't it? Self-wealth, I know, you can do US shares. I'm not sure, open market there, are they doing US shares as well?
Oh, I think they will be. I think it's on the horizon, yeah.
Yeah. So, that's improving. And I was just going to say, and so that makes it, to me, more exciting, because then if you can buy some US shares, then, if you're an Apple lover, you can buy yourself some Apple shares. If you're every second day on Amazon ordering something, well, go and buy yourself some Amazon shares, Microsoft, Nvidia, whatever floats your boat, right? Spotify or whatever. So, in fact, I could be. Oh no, Spotify is listed. But it's a bit easier to follow a lot of the things that we use every day if you can get into the US market.
Yeah, but then you've got to be like, well, if I'm going directly to the US, I'm going to have to fill out their IRS tax forms every couple of years. So it's
pain in the ass. Yeah.
Yeah, that's right. So, okay, it's just one of those things. Like, work out a diversified fund, and I use a good example is the Vanguard Diversified Growth Fund. It's 70% growth, 30% diversified. Like, that's a pretty smooth portfolio. Hold it for long enough, will do exactly what's on the box. And, the more fun and sexy our investing is, the more it's not investing.
But I guess that circles back, and this is sort of what you said earlier, or just now, the idea of those satellites, right? So if you've got your core is something, like a Vanguard fund or something like that, that's really diverse and low risk, you can have a bit of fun with a few of your satellites. Why not,
like one of my satellites is InvoCare Limited. Right. And, I got it at a good time. I've had some growth, and I just think because they're like the major license holder for cremations and funerals and all that in Australia and Singapore, and we're only getting older. So, and this is not advice, I'm just sharing what one of my satellites is. It's just out of personal interest, I hold some shares there, like for no other reason. I scratch that itch, but I've just got the view in my life, Paul, that I don't do more than 10% of my entire portfolio in direct shares because it gets a bit too much like gambly, glenny. And we don't want to be gambling with our shares now.
Right, fair enough.
I want to talk about LICs. What's an LIC?
A listed investment company. So,
and why would I use an LIC?
Yeah, good question. So, what would help here is just a little bit of chronology, right? So, LICs have been around forever. I think the first one in Australia is 1924, thereabouts, right? So, a long time. And they were kind of the first funds, the first things you'd get into where you buy one of these LICs on the Australian share market, and then they'll hold a portfolio of 80, 100 different shares. So they were a good first step. And then managed funds come along in, I don't know, the 80s or so. And they kind of had some improvements on LICs. They weren't listed on the stock market. The problem with LICs is that sometimes they didn't trade for actually what they were worth. And managed funds really solved that issue. They also made it easy for you to add and get money out. I mean, it took a little bit longer than what shares did, but you didn't have to pay a whole lot of brokerage. And brokerage is cheap these days, but it wasn't always the case. It used to cost hundreds of dollars just to do a single trade. And so, that was a bit of a problem with LICs. Managed funds solved that. So managed funds solve various things, but generally they're probably a bit more expensive. They had their own issues, right? And they're still relevant today, managed funds. But the next evolution really was exchange-traded funds, ETFs, and that's what so many of us are familiar with today. And so that's been the progression. And today, ETFs, very much like managed funds, but they're listed on the stock market. So they're back to what LICs used to be. And that works because brokerage is a lot cheaper now than it once was. But ETFs still share the mechanism with managed funds that if there's more people that want to buy than sell, then they can create new units. And if there's more sellers than buyers, then they can cancel units. And so in that way, they can make sure that the ETF trades for actually what the underlying portfolio is worth. Now, LICs, they don't have that mechanism. So when they start a fund, they might go out and raise whatever, 20 million, 100 million, whatever it is. And then let's say if I buy into this LIC XYZ LIC, and then 3 years down the road, I want my money back. I've got to find someone to buy it. So I sell it to you, Glenn. Now, that portfolio, I might have put 20 grand in, and that portfolio has maybe, the underlying investments that the fund manager bought. I might have put 20 grand in, it might be worth 30. But if Glenn's the only one that wants to buy it and he only wants to give me 25 grand, well, then that's what I've got to take, right? There's no way for me to say, all right, well, the underlying investments are worth this. I want to realise that value. With an LIC, I've got to find someone else that wants to buy it and accept whatever price they're prepared to pay. Now, for the really big LICs, that's kind of okay because there's enough buyers and there's enough sellers that they find the right price, and the LIC providers will put on their website, here's what the true value is. So everyone's got a reference, right? It should be worth $10 a share. So you can look at it. Sometimes they're a little bit lagged in the, they'll have the net asset value they describe it as, and it can be a few weeks or even a month old, but you've still got a pretty good reference point. So the big ones are pretty good at being accurate, but some of the smaller ones, not so much. And if you've got a minute, I had a bit of a look just as an example. I was looking at different smaller LICs and one I saw there, and look, I don't want to pick on these guys particularly. It applies to lots of different ones. But there was one there I saw called the Fat Profits Global Contrarian LIC.
Oh, sounds sexy. What's the ticker?
FPC. Now, the net asset value on that as at the 28th of July, so quite just in the last few days, was $1.36. But the share price is $1.20. Now, there could be a bit of difference. It could be a bit of a difference because, maybe there's a little bit of tax embedded in there, but it really doesn't explain the difference, right? So although the underlying portfolio per share is worth $1.36, if I wanted to sell it, all I could get is $1.20. Now, you're right. You could say, all right, well, as a buyer, that's cool because I'm spending $1.20 and I'm getting $1.36 as value, except that one day you're going to have to sell and, the gap's probably still going to be there, right? So this is the challenge with LICs. So to your question about, do you buy them? Do they make sense? To me, when you've got ETFs available, I don't quite see why you'd go an LIC. Like, I don't see what an LIC gives you that an ETF doesn't. Maybe there's an argument that it's stickier money, so in a down period, perhaps it holds up a little better. I haven't seen a lot of evidence of that, but it's an argument. I mean, if you had them already, I probably wouldn't sell them and trigger capital gains or anything, but personally, I don't see a great need to be buying LICs. I'd just buy an ETF instead myself. Yeah. How do you feel about them?
Well, it's funny. I did cover it in my book for housekeeping, and I basically said, in the money world, you're either for them or you're agnostic about them. I'm probably more agnostic about them. I don't care, and I don't own any myself, and I don't see me buying any myself because, it's just... and I get that there could be ones that they might be doing some cool things. And if it isn't clear, Woolworth is a listed company and how they make profit for their shareholders is they buy goods and sell them and, make some money while doing that after they pay staff and rent. Where an LIC, how they make money for their shareholders is buy companies for cheap, maybe sell them or just hold on to them and reinvest and buy other companies. So it's just horses for courses, and I'm pretty agnostic, and I don't see myself owning any anytime soon.
No, I think we're on a similar page there.
Well, we're going to take a quick break, and we'll come back, and I want to just talk to Paul about gearing and debt recycling, and maybe what investments we use with each strategy. And remember, if you do want to buy Paul's book, you can do so. There's a link in the show notes, and all profits goes to Paul's pocket.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to sortyourmoneyout.com. Click Get Help and we'd be happy to introduce you to one of our trusted advisors. Our panel of advisors, mortgage brokers and accountants work with clients all over Australia so they can connect with you wherever you are. That's sortyourmoneyout.com and click Get Help.
We're back. Gearing and debt recycling. You actually mentioned in your book that it fascinates you where people go and buy property with 100% debt, but will freak out about leveraging into equities. And I must confess, in recent times, I've been thinking the same thing. I never used to recommend in my financial planning business gearing into equities, more so because I didn't want the stress of people ringing up freaking out. I just thought I would like to sleep more than my clients, and we just kind of did bread and butter stuff. But it's a legitimate strategy for wealth creation. So, what's your view on gearing and maybe debt recycling?
Yeah, it is super interesting, and we actually, as part of the financial planning process, obviously, Glenn, you've had plenty of practice at this, but it's important with new clients to have a good discussion about attitude towards risk. And so one of the things we talk about there is, well, how do you feel about borrowing to invest? Because it's good to get a read on people's attitude and their aggressiveness and their comfort with volatility. And I had this discussion just on Monday, actually, with a husband and wife. And how do you feel about borrowing to invest in property? Yep, absolutely. On board, let's do it. Okay, how about borrowing to invest in shares? Wife was thumbs up, all good. But husband, nah, not real comfortable with that. So why is that? And he said, well, because at least with the property, I've got rental income all the time. Even if it doesn't grow, it's still producing income. I'm kind of okay with that. Whereas shares, all my bet is that it grows in value. And I said, well, that's not quite right, because you get dividends on your shares too. And he's, oh, yeah, I hadn't thought about that. I mean, to be fair, the dividends are only every 6 months, whereas your rent's typically once a month. So it's not quite the same degree of regularity, and of course you need to pay your loan monthly. So I kind of see where he's coming from a little bit. But you gear into investment property and the tenant moves out, you still got to make your loan repayments, and it could be empty for a few months, who knows. But plus it's just basic wear and tear on the property. Whereas you gear into a share portfolio, look, your dividends move around a little bit, but you're never going to get zero dividends, assuming you've got a portfolio. You're always going to get some income, and it's reasonably constant and reasonably predictable too. And of course, in both cases, you're hoping that they're going to grow. So I think gearing into shares, and I'm not talking masses of leverage here, right? So definitely, you want to get some advice, and you want to be thinking about what makes sense and how much risk, and obviously time frame's important. It's not something you're going to do for 1 or 2 years. Even 3 years. But I think there is a place for gearing in the right circumstance, and in actual fact, it's a lot less risky than gearing into property. It's more diversified, more predictable income, easier to liquidate if you had to. You haven't got stamp duty and all sorts of other costs associated with a property. I think there's a lot of positives there, yeah.
The problem is, I see these are the two big problems that I see with gearing into shares. Number one, the educational issue, which you've talked to, and a good couple of sessions about understanding how markets work and all that stuff, that really can be put to bed, that issue, as far as I'm concerned. But the second issue is, probably mainly why I didn't actually do these recommendations in my business, is because of the liquidity. People might want to change their strategy on an emotional whim, where it's actually harder to do that with an investment property because it's more clunky, more cost, more time to sell the property. So that's kind of my vibe on it. Absolutely knock yourself out, buy shares. Absolutely knock yourself out if you want to gear up, or if you want to do some debt recycling, because I want to talk about the two differences. But you've just got to make sure your strategy's locked in, and you don't get a flashy light in the corner and a new shiny object and go, oh no, I want to do something else. I'm going to sell my shares and pay down the loan and rinse and repeat somewhere else. Do you think there's a behavioural risk there?
Yeah, there's the potential. I have to say, of the clients I've worked with, I can probably only think of about one instance where that occurred. And to be fair, it was just a change around. They thought they'd be renters forever, and then they decided, actually, we want to buy a house.
Well, but that was also what I was going to say, Paul, is, you having an advisor in your life can be that, true north sounding board accountability that could be worth the couple of grand a year that you pay to have that person go, no, you're not bloody selling. We're doing this for 10 years. Piss off. But you do that nicely.
Yeah, it's not quite the words I use, but yeah, I hear where you're coming from.
Yeah. So a lot of people talk about, setting up a second mortgage on their house, and we'll just make it 100 grand. They've got equity on 100 grand. And you see it in the Facebook groups. I want to do debt recycling. What should I do? We have to be clear. Is it a gearing strategy or is it a debt recycling strategy? Because for me, if I'm gearing up, I want growth, baby. Like freaking 100 grand Afterpay shares 2 years ago. Take me to town, baby. Spank me sideways. America, pew pew, all that stuff. I'm not buying Afterpay, but you know what I mean? Where at debt recycling, it could be, well, we want to invest in income stocks to just help service the mortgage and we'll get some growth along the way. What's your view on this?
Yeah, I don't think they're so different. I think if you're going, your example there, the Afterpay or whatever, you're going super aggressive, I wouldn't be gearing to do that. Just do that with your own savings. So for me, and in terms of what we would recommend with clients, if you're gearing, it's going to be a diversified portfolio. But you're dead right that in terms of debt recycling, to make that work, there's got to be some income. So I guess just to step back for listeners, debt recycling, what that's talking about is the idea is you've got usually a home mortgage and which isn't tax deductible, of course. And so, but you've got some equity in your home. So what you're doing is you borrow against your home, Glenn's example there, 100 grand. You buy some shares with that, and then the dividends that you get off those shares you use to make extra home loan repayments. And the train of thought goes that that's attractive because you're reducing the debt that isn't tax deductible, and you're probably just paying interest only on the other debt. Now, the wrinkle in that is that the banks often, the interest rate is lower on your primary mortgage versus the investment loan. And so sometimes it doesn't produce a huge benefit, but it can work. It just depends on the cost of your borrowings and how much you can borrow. So it's a bit horses for courses. And I do feel, to be honest, you said about in the Facebook group and that, I think sometimes people kind of perceive it as like it's free money or it's a magic pudding or it's kind of something bigger than it really is. It's actually not really that complex a strategy, and it doesn't kind of just rain money on your head. There's kind of not that much to it, But anyway, look, that's the mechanism of how it works. And yeah, it's just about having a diversified portfolio. But it can be good for some clients.
But it's also like it speaks to stock selection and your strategy, whether you have surplus income at the end of every month or do you need the asset to actually help pay down that loan?
Yeah, that's true. I mean, typically we'd only be doing it if they did have the surplus income to pay it already, because the dividends are only 6 monthly, right? I mean, there's the occasional ETF that does quarterly dividends, but they're pretty lumpy. So we wouldn't be recommending it if you didn't already have the cash flow to meet the loan.
We might leave it on something I've been wanting to just kind of address for a little while. When we get, and we'll make a number up, okay? We'll make a number up that over the last 5 years, and we'll use BHP as an example. BHP did 10% return, annualized 10% a year, okay? Mm-hmm. That return, and this is interesting, so when people are looking for equities or ETFs, a lot of the online research will actually tell you the breakdown of that return to growth and
growth versus dividends,
Yeah. So that's kind of another feather in your cap to have when looking at investments over the last few years. Like, for example, we used to call Telstra, Australia's best online bank account because they were highly yielding.
Yes.
You'd park money in Telstra and it just print like dividends all day long. So I think that's important. I'd get your view on this, Paul. When looking for your investments, do you want shares or ETFs that are focused on that growth, or do you want that, value stock that's going to humming along and just spitting money out to their shareholders?
Which comes back to, before you do any investing, figure out your goals.
Yeah, it bloody always comes back to goals, and it pisses me off, Paul. I just want to spray my investing shotgun and invest in everything, but it sucks, doesn't it?
Yeah, because that's what it's all about. If you need income, it depends what the objective is. If you need income, then you got to go the dividend payers. But if you don't, there's a good argument actually for tilting it towards growth if you don't need the income, because the capital gains tax, so long as you hold the asset for more than a year, you pay half the tax on it. So
you kick the tax down the road.
Well, you kick the tax down the road, but also it's a halving of the regular tax rate. So you pay half as much tax on a capital gain. If you made $1,000 capital gain versus $1,000 of income, you'd pay half the tax on the capital gain, assuming you've held the asset for more than a year. So there's a tax rationale for favouring capital gains over income, but it just depends if you require that income. I always find it interesting, something like Amazon has never paid a dividend. extraordinary successful stock, and people that have owned it for a long time have made squillions, never paid a dividend. So, some people get really tied up in, I've got to buy stocks that pay dividends because that's what my grandfather told me to do. Not really.
Yeah, but I think that's a cultural thing. Like, you look at America, land of opportunity, you build your business and you can just keep building and, we're capitalist pigs and all that. Let's just keep investing and growing. Dividends are a weird Australian phenomenon.
Yeah, it's a bit tilted because of the franking credit system that we have that most others don't have.
Yeah, true. Good point. Well, we've had a good yarn. If you like what Paul's putting down, you can jump over to his podcast. It's called Financial Autonomy, and you can give it a like, a subscribe and all that crap.
Yeah, and actually, Glenn, could I just make a mention? I know you jumped on the other day, but I've got a bit of a new project going on at the moment called Market Noise. So we've done 2 episodes so far. So it's on YouTube. I'm doing it with Justin Balduri, who some of your listeners might know. And, we do a live show on YouTube on a Monday night, and then it comes out as a podcast. So still, check out the Financial Autonomy podcast and you can give it a listen. But, Market Noise, something different, a little bit like what you and I are talking about today. We just jump on and sort of chew the fat on what's interesting stuff that's come up on stock markets for the past week. So, if people want to get in on the ground floor, I looked this morning, we had 22 subscribers. So it's literally right at its infancy. So any help you can get in there. I dare say if you go on YouTube and search Market Noise, I'm pretty sure the algorithm hasn't quite got us to the top of the list, so you might have to scroll through a little bit. But we're having a bit of fun with that, and right at the outset of that. So if any of your listeners want to help us out getting a little bit of momentum, that would be awesome.
Yeah, I'm sure they will, and I'm sure I'll send you a bill for $3,000 for promoting it on the show.
No worries, mate.
Nah, it's all good. Hey, Paul Benson, Financial Autonomy, thank you so much. You can check his podcast out, his book out, and his new banging YouTube show. And that's right, I did jump on there the other day. I trolled you. Well, I said hi or something like that and had a bit of a watch. And
thank you.
Yeah, just keep encouraged, everyone. That's all you can do, because it's more about being encouraged and making an investment, right or wrong, than not being encouraged and spending your money on crap.
True enough. Great way to leave it.
All right, ta-ta.
We acknowledge the Darkin young people, traditional custodians of the land on which our studio sits, and pay respect to their elders, past and present. We extend that respect to Aboriginal and Torres Strait Islander peoples who may listen to our podcast.
My Millennial Money supports A21, a charity focused on abolishing slavery and human trafficking all over the world. Check out a21.org.au for more info. If you would like some other giving options, or if you're unsure about which charity you can support, head to thelifeyoucansave.org.au.
This podcast is for education and entertainment purposes. Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement and obtain appropriate financial advice tailored to your needs. Simo Interactive Proprietary Limited, the publisher of the podcast, is an authorised representative of Money Sherpa Proprietary Limited, which holds financial services license 451289.